Now, why are money market funds going to have different interest rates in terms of returns? And I know that is a question that you have been asking yourself. Why different money market funds are going to have different interest rates in returns? All right. What do I mean? You find that money market fund A is going to offer an interest rate, for example, of 16%. Now, money market fund B is going to offer an interest rate of, let's say, 14.50%. Now, money market fund C is going to offer an interest rate of 12 or 11.53%. Now, this is a question that you have been asking yourself. Why is it this money market fund has a higher return than money market fund B and also in money market fund C? That is a question that you have been asking yourself. And ladies and gentlemen, guess what? I'm going to give you two good reasons why we are going to have variance or differences in the interest rates in money market funds. And the first reason, number one, we are talking about risks undertaken by the fund managers. We are talking about risks undertaken by fund managers. Now, we said a fund manager is a professional person that have been given the authority to run a money market fund, of course, by the Capital Markets Authority, and have been licensed to run a money market fund. Now, risk undertaken by the fund managers, we are saying that in the returns and the risk, there is something that I need you to get. Returns will always go hand in hand with risk, because we normally say the higher the return, the higher the risk, and the lower the return, the lower the risk. And remember, in our previous videos, we said that one of the reasons why money market funds are going to have low returns is because they have low risk. Because where there is returns, we talk about risk. Where there is low returns, there is low risk. Where there is high returns, there is high risk. Now, if fund manager, the reason why we have 16% here, we have 14% here, and 11% here. These are three types of fund managers. All right. This one is a risk taker. This one is a risk taker. This one is a risk neutral. This one is a risk neutral person. Neutral, or it's a risk neutral fund manager. This one is a risk averse fund manager, whereby this fund manager is going to go an extra mile and take some risks, invest the investors' funds in different investments without fearing, and that's why they are going to get higher returns. We said the higher you risk, the higher the chances of getting a higher return. But remember, there is aspect of regulation by the Capital Markets Authority. So even if they take risks, there is up to a certain level they cannot take risks, because they are regulated and given guidelines on how they are going to invest the money. Remember, there is also the aspect of independent oversight. So the custodians or the trustees of the money market fund are not going to provide these funds, because they hold the assets for the fund manager. And when they realize that the fund manager is going to averse a lot in terms of the risk. So if this person or the fund manager takes a lot of risk, then they are going to get a higher return, and of course ensuring that the investors have high returns. This fund manager C is going to take low risks when it comes to investments. So they are not going to take investments that have high risk. They are going to take investments that have low risk. And that's why they will offer low returns to their investors. That is the first reason why there is a difference between interest rates in money market funds. And we are talking about risks undertaken by fund managers. This one is a risk neutral. So they are going to be there. They are going to compare projects that have low risk and high risk, and they are going to compare and make sure that they have invested their money accordingly. Ladies and gentlemen, you don't have to worry about the risk undertaken by the fund managers. Remember, these people are professionals and they know how the market runs, and they are going to make sure that they have protected their money. And of course, based on the guidelines and the principles that have been issued by the Capital Markets Authority. The second one is actually the diversification by fund managers in terms of investments. Diversification by the fund managers in terms of investment. If you find that fund manager A has diversified a lot in terms of investments, so they have invested in treasury bills, treasury bonds, they have moved on to invest in corporate bonds, they have purchased a lot of commercial papers to entities that needs funds, and therefore they are going to generate a lot of income and a lot of they are going to generate a lot of income. They have also issued money to other borrowers, short-term debt securities, and so on and so on. So the cash flows of these fund managers are going to be very high, and of course they are going to, with the high cash flows and the organization doing very well, they are going to ensure a high return to their investors because they are operating with investors' money. Now, if other fund managers have not diversified, this is a fund manager that has neutral diversification. They have not diversified so much, and they have not diversified less, and that's why they are going to offer a neutral or a return that is just in the middle. Now, this is a fund manager who doesn't like to diversify a lot, or doesn't like to subscribe to those debt instruments, and therefore they don't have a lot of diversification. That's why they are not going to have a lot of returns. Hope you're understanding what I'm saying. So diversification by the fund manager in terms of investments, investing here and here and here, is another reason why we are going to have variance or differences in the interest rates offered by money market funds. Ladies and gentlemen, I hope this information was informative, and that's why you'll see why you should invest in this money market fund, why you should invest in this money market. But all in all, we said that before you invest in a money market fund, make sure that it's listed in the company, in the Capital Markets Authority, just to be protected, and make sure that your funds are very okay. Professional accountant Sir John Mweri here. Thank you for watching this video. In case you need to add any comment, put it on the comment section. In case you need any consultancy, it's a call away. This is Xfinop Accountancy and Insurance Consultancy. Thank you so much for watching this video. Just think about that.